Hi legends, big day today, interest rate, Fed interest rate decision, what will it come out as? Thanks for joining the stream, I see all of you here. Andy, welcome in the house. Legends, what is up? A couple of minutes to go. What is the time over here? Let me just check. Ooh, 2 more minutes, legends. What is going to happen to the price of Bitcoin? Can we expect a massive pump here to the upside, or are we going to crash down? Right, let me share my screen. As you can see, I'm watching the news over here. Let's see what the interest rates comes out as. Okay, let me just put the music soft over here, so that's not a distraction. I want to just see if you guys can hear.
Comes in December. Even with all that really constructive language about what we've achieved.
Let me know in the comments if you guys can hear this. Right, just getting this ready for the news. Right,
we're going to be parsing through every iteration, every word.
Legends, let's have a look at the price of Bitcoin. Obviously, we are expecting the Forex calendar. Let's open this up over here. 8 o'clock, 34 seconds to go. The forecast is 5.5%. Previous is 5.5%. So anything below is obviously going to have a positive impact here on the price of Bitcoin. Let's see what happens. Do you have your shorts and your longs ready? Okay, I do not trade the news. I'm sitting on my hands and I'm just waiting for price to settle a little bit. Let's see what's going to happen. 8 seconds. And let's see. Pending. Is the news out? Come on. Give us the numbers. 5.5, exactly as expected. And we have a dump here from the price of Bitcoin, right? Market wanted at least a little bit better. And now we're getting a little bit of dumpy action here to the downside. Or is it just a flush out? Could this be a flush out? Legends, I do not trade the news. Welcome to the live stream. We can watch the Fed meeting here together. I think that's at 8:30 if I'm not mistaken. Getting a little bit of dumpy action over here. Legends, this is why I stay out of the market when there's massive news events, because you're going to get a week down and maybe the Fed conference starts and Powell says something dovish and then you get a candle here to the upside, and I just sit on my hands and I wait for price to slow down and consolidate and for the market to absorb the news. Okay, was this perhaps just a retest of the trend over here? Okay. Interest rates came out exactly as expected. Okay. Federal budget, okay, not really high impact news. 5.5, 5.5, 5.5. So previous month 5.5, forecast was 5.5, and we got 5.5. Right, so not really positive or any massive volatility. Oh, I see Ethereum had a little bit of a dump here to the downside. Ethereum did not like the news. Or is this just a retest, legends? Is this just a simple retest? Can we expect momentum to continue here back to the upside? Is this just a little shakeout of all the longs currently in the market? 𝗖𝗍𝗂𝗍, Bitcoin dominance still exactly where it was. Total 3 still got the bounce. Not much happening here at the moment, legends. Welcome to the stream. 26 of you watching. 8 likes. Smash up the like for the alpha over here. Mr. Dev, welcome in the house. Timo, hi Devil, amazing day. Last similar double day was 2020. Okay, cool. Greetings from the Netherlands. Robert, thanks for joining the stream. Valerie, Andy, nice to see you. Yes, Andy's in the house. Dinesh, how's it, Devil? How are you? I'm very well, thanks, Valerie. And Hemra, hi, welcome to the stream. Irina, thanks for joining. And a little bit of dumpy action here. Legends, this little trade over here was actually a little bit of an inside joke within the Bitcoin Census community, where I shared a presentation or something, and I was just like, well, if I had to take a trade right now, this is the trade that I would take. And it literally played out in a couple of minutes, okay, I said, well, this is good risk to reward, 5 point or 6 risk to reward. This is the trade I would take. Tight little stop loss. Price was trading literally over here, and then we got this massive green candle here to the upside. So just a little bit of a fun trade. I don't think anyone took it because they thought I was making a joke, and then the trade played out to perfection. Nonetheless, legends, we have broken trend, okay, just purely from a trend line perspective. We have broken trend. We have more green volume here to the upside. Also, what I have noticed is if I take a fib extension from the low to the high over here, 618, can you see where we are consolidating? We got the rejection by the 1.618. We got acceptance above, but now we're struggling. Okay, so was this it? Was this a 1 2 1 2 1 2 3 4 5? Or we busy with the fourth wave? 1 2 3 4 5. Right. We're gonna have to wait for the Fed, the meeting. The meeting is usually where the action happens. Okay. At 8:30, if I'm not mistaken. 8:30. FOMC press conference. Okay. I've got the news ready over here. We can watch it together. I'll obviously put it on live.
It is an okay pace to move to get.
And we'll see what is cooking over here. Okay. Right, legends. Just want to open this up here quickly for everyone as well. Andy, our last live stream together, absolutely epic. Right, legends, down in the description, these are the exchanges that I use to trade. Bluffin, Bybit, and 𝗞𝗖. The biggest bonuses, 80k bonus when you trade with 𝗞𝗖, no KYC required, and you only qualify for these bonus by using the link downstairs to sign up. Right, legends, what is up here with the price of Bitcoin? Okay, let me switch on some analysis. And I really don't like to do heavy analysis on the price of Bitcoin when we have a big news day like we have today at the moment. Switch on some today analysis. The one thing I discussed this morning during my YouTube update is we tapped the 0.618, okay? Taking a fib from this high to the low over here. What I mentioned this morning, legends, during my YouTube update is to say that if we get momentum back here to the upside and you want us to still come and claim the low, I wanted us to reject here by the 50% fib level. Okay, and I said once we tap the 0.618, we increase the probabilities to first go and claim the high before we claim the low. Okay, and I have a little line here, a little funny line over here that says go higher. That was my signal over here, is to say that I want to go higher. Well, price is most likely going to go higher, potentially coming to claim this high over here if we tap the 0.618. And the simple reason for that is a little bit of education over here, okay? I was purely looking at this from a 1, 2, 3, 4, 5 to come and claim the low again. And because we tapped the 0.618, even the 786 and even the 0.88, you know, when you take a fib from the high to the low and you start dancing around the 0.88, you increase the probabilities of coming to claim the high over here before you claim the low. So let's see how this plays out. Okay, all dependent on the news. And I mean, we know what the news can do. The news can literally, you know, give us some crazy volatility or a massive pump here to the upside, then a dump to the downside. It's just you never know what's going to happen with these news events. Okay, if you're a news event trader, I mean, you've obviously got a plan, good risk management, good luck to you. I don't trade the news. Okay, but purely from a technical perspective, this still for now, still looks bullish. We are at the 0.88, which increases the probabilities of taking the high, potentially a retracement to the 0.618, and then you're off to the races to come and claim the high. This is purely from a technical perspective. So let's see if this plays out. And that was what I shared this morning in my live, in my YouTube update, is to say that, well, once we claim the 0.618 over here, we increase the probabilities of coming to claim this high. And now I'm interested to see, well, will this play out? You want to claim the high before you claim the low, right? So based on the news, let's see. We also had a value area high and a value area low over here. During the update, I also said that when you reclaim the value area high and you can test it as support, you're most likely going to find continuation to the upside. which we did. So we had all the bullish signs, you know, the momentum, sharp momentum here to the upside, getting acceptance back above the previous day value area high. When you switch on your session volume profile, you guys will see, just wait for that to load up. Previous day value area high, we got acceptance back above, we retested it at support, broke the 50% fib level, smashed through the 618,786, and now it's decision time. I think it looks like Bitcoin is waiting for the press release. Right, legends, let me zoom out a little bit over here. I will be honest with you guys, and just want to make sure that everyone can see. Yeah, this Elliott wave structure, okay, or this wave structure, let me not use the word Elliott wave. This wave structure is extremely confusing. Okay, it really looked like a 1, 2, 3, 4, and then what is this? Like, what on earth is this? Truncated fifth wave, very rare in Elliott wave theory. Was this 1, 2, 3, 4, 5? Doesn't make sense. This wave doesn't balance out compared to the second wave over here. So I mean, is this a B, C to the downside? We invalidated, like I said yesterday during my live stream as well, we invalidated this bullish structure. Okay, when we took the lows over here, we invalidated the structure, and it looked like this was the structure that was going to take us out of this consolidation, completing the fifth wave, and then this happened, right? So perhaps, okay, there's a chance that this new structure that is forming over here could be the structure that's going to take us to higher levels. So what I mean by that, when I zoom into the smaller time frames, what you would like to see for bullish momentum to continue here to the upside, if this is the local top for now, when you take a fib from the low to the high, very interesting. Okay, maximum target 786. Right, so if we do find momentum here to the downside and we bounce here, maximum target at the 0.786, there's still a chance that we can find higher levels. But the 618, the 50%, and even the 382 will act as support as well, because that's basically second wave targets. 1, 2, you know, 1, 2, whichever level it's going to find, it needs to find support here without coming to the 0.88 and the low. If we're going to take this low, we increase the probabilities of going down much lower. Right, so perhaps this is the structure that's going to take us to claim all-time highs once again. Okay, what's the time? 8:10. Let's go through some comments over here. Valerie, Andy Bitcoin, you are very welcome. Hello from Los Angeles. Miss Melanie, thanks for joining the stream. I'm sure you're happy that I'm doing a later stream and now you can join. Alan, hi 𝗬𝗍𝗍. Andy, I think we go higher when Powell speaks. My prediction, no financial advice. What is your prediction? Let me know in the comments. Do you guys think Jerome's going to be dovish or he's going to be hawkish? Okay, for those of you that don't know the difference between the two, dovish basically means he's trying to, you know, put a little bit of emotion. It's going to be okay. We've got this. Or is he going to be hawkish and be very strong in their stance? We will continue and we will not increase interest rate hikes, or we will not decrease interest rates hikes. Things are not looking good. You know, is he going to come with a bad energy in terms of enforcing their power? Or is he going to, you know, give us a little bit of hints that interest rates might be going down, or perhaps the money printer is going to go grrr? What do you guys think, right? Is this is decision time? Can you guys see how the market is waiting? The market is waiting. We broke trend. We're currently dancing around this area. So do we get acceptance back below the trend, or do we continue momentum here to the upside? It kind of looks like it's decision time over here, and the market is waiting for Mr. Jerome. What do you guys think? Let me know in the comments. Okay. That is basically what I see here on the price of Bitcoin. I just want to zoom out here a little bit. I mean, there's still a lot of work that Bitcoin needs to do to come and claim the all-time highs. Just want to go back onto the 4-hour. Okay. Range. Let's bring this up quickly here. We are currently still inside of the range. I'm going to want to see some magic over here. Legends, we need to break the value area high here. Okay. And I would like to see some nice, you know, we've got some nice green volume kicking in here. Obviously, it's news driven, but I would like to see the green volume continue here to the upside. I want to see us smash the value area high over here. Perhaps a nice little retest, okay, on lower volume, and then off to the races we go. Are we finally going to get that push up here? Okay, we've just been deviating above, deviating below, and we are still inside of this range, just chopping up and down at the moment. A good thing that I must acknowledge over here is that we have found acceptance back above the point of control. That looked really bearish during today and yesterday, is when we got acceptance back below the point of control, which increased the probabilities that you're most likely going to come tap the bottom of the value area low over here. But at the moment, we're trading above. Okay, so we still have a chance, legends. Let's see what's going to happen. Okay, Oru, Tranquil, hi Devilled, Shankar from India, welcome. Thanks for joining the stream, I appreciate it. Hi legends, Julian, welcome. Not a good idea to do anything right now. Let's wait. Yes, I agree. Rudy, have a nice time trading. Greetings from Antwerp. Thanks from Belgium. Welcome, welcome. Yes, I'm also sitting on my hands. I do not trade news events. I used to when I started out and lost some money. It's difficult to exercise good risk management, and also news events don't really respect technicals. They break the rules. Okay, but it's still fun to watch the volatility and see what could happen. And I mean, if you do have some play money or gamble money, you can, you know, bet a $50 or a $10 to the upside or to the downside, depending on what you think is going to happen with the Fed. Completely up to you. If you have some gamble money to throw away, definitely. I'm not going to trade the news event over here. Right, legends, we are still above my go higher line over here. Let's see how this plays out. ETH, Mr. ETH, what are you doing? Are you just getting a bounce over here? Also did analysis on Ethereum in my YouTube update this morning, where I mentioned don't like this straight candle here to the upside, and the fact that we tapped the range low over here and we had multiple candles close below. You want to see price move away. For Ethereum to remain bullish and to come and claim this high again, you don't want to come back to this line. Okay, that's the range low strategy rule over here. If we had to come back and tap this level for a second time, you increase the probabilities of coming to fill this gap, and potentially we will bounce here on the 786 at around $3,000.98 or 94, give or take. Okay, let me just zoom out. $3,000.98.70. Let's see how this plays out. So for bullish momentum to continue here on the price of Ethereum, we need to hold above this line. Let me just snap it on there with a magnet. Okay. Let me go, yeah. Okay, snap it on there with a magnet, make it nice and red so it sticks out. Okay, we need to remain above this line and not tap it for a second time. If we tap this line for a second time, we most likely coming down here to $3,000.98. If we hold above and we don't tap it, we have a chance to go and claim the high over here. Okay, right, legends. Hi, legends. I think as usual, you will speak lots of words, but no hawkish or dovish. And we will have, after volatility, small decrease in price. Mr. Mole, yes, I think, you know, last couple of Fed rate decisions and press conferences that I watched, it was so boring, and price literally just went sideways. And then when the press conference was finished, it's almost like the market didn't know what to do. It's like, we didn't get the hawkish news, we didn't get the dovish news, now what? Okay, let's just continue with what we are busy with. Right, so what is going to happen? Let me know in the comments down below. Do you guys think it's going to go up, more bullish? Are we potentially going to come and claim these highs over here, these local highs over here? Do you guys think we're claiming the local highs or the low over here? So let me maybe start a poll. Let me see if I can start a poll over here. Let's do this. Which comes first? Which comes first? Okay, let's see. Let's say $72,160. $72,160, or let's call this 66. Let's just call it $66,000. Okay, which comes first? Just out of interest, let's play a little game over here. Let's do this. $66,000. Let's go. Let's go. Let me know in the poll what you guys think. Which comes first? 72, 160, or $66,000 based on the FOMC meeting that's going to be held in 12 minutes from now. Okay. Right, legends. Like I said this morning during my YouTube update as well, there is still a key level that I'm watching over here. If we do lose this low over here and something happens and the news is bad, whatever the case might be, if we do not claim this high over here and we start tumbling down, I am still looking at this range low, okay, for potential long year to the upside. This was a beautiful SFP over here where we dipped in, we got acceptance back above. There was a nice bullish CVD that kicked in as well. I wanted to show you guys this, okay. Let me just refresh over here. A beautiful story that CVD told us over here. Absolute beautiful story. Okay, when you look, I'm here on the 5-minute time frame, and local CVD takes priority, and that's why I'm always here on the smaller time frames on CVD. Can you guys see this movement here to the downside? Okay, beautiful movement here to the downside. Lower highs, lower highs, lower highs, lower highs, lower highs, and CVD just moving up, moving up, moving up, confirming each movement down, constantly taking the targets and taking the lows. And then at one point, we smacked back down and we started consolidating. There was another liquidity grab, if you want to call it, okay? And then the market shifted. Something magical happened. I just kept on seeing bearish CVD forming all over the place, even between this pivot and this pivot, bearish CVD. And then when we had this dip here to the downside, I saw this bullish CVD for the first time during this entire structure over here. I started spotting bullish CVD on both yellow and blue, and that was the ticket. You had a pump here to the upside. You had a perfect retracement to the 0.786 bullish CVD, and then what happened? Look at where we are right now. Okay, and there was just continuous bullish CVD building up between all the pivots on blue. And even as price moved up here, CVD on blue kept on falling down, creating more additional bullish CVD, confirming price moving to the upside and continue to take the highs over here. So quite a beautiful story that CVD told me over here. Okay, continuous bearish CVD confirming the movement down, and then for the first time where I spotted bullish CVD, bam, off to the races. And this SFP was also in alignment, okay, when I zoom in here, was in alignment with this. Let me just clean this up here quickly. Perfect alignment with this. You SFP from the low over here, okay, you get acceptance back above, you have bullish CVD. It's almost like the planets are aligning, and look at where we are today. Okay, absolute beautiful trade for those of you that did take it. I do want to highlight that if we do find momentum to the downside, the next pivot I am watching is this one over here. Okay, this to me is a high probable trade where you can at least expect a bounce, but perhaps, you know, the market makers front run this beautiful idea that I had over here. And what I liked about that level is that when you take a fib from the lows to the highs, you have 50% fib alignment with this range low over here, the range low. And then also when you take a fib from this pivot to the high, you also have the 618 in perfect alignment. So it felt like perhaps there was too many planets aligning over here, and then the market front run the idea. Okay. But if we do have to find momentum here to the downside, if we come and claim this low again, I'm interested in this zone. I want to see how we're going to react over here. We have the 0.618, we have the 50% fib level, and we have diagonal support. Okay. Right, so let's see, legends. Let's clean this up. Okay. Let's go through some comments over here. Rudy, they're talking about planets. How is the moon phase trading going? That's an interesting question. Let's go on to 8 hour. Do I still have the moon phases over here? Speaking of planets, not that the moon is a planet, But nonetheless, look at this. We had a false signal on these moon phases over here. I mean, they've been playing out beautifully. You have a full moon and it just aggressively pushes up price. You have a new moon pushing price down. Full moon pushing price up. Can you guys see how beautifully it just played out the whole time? But then something went wrong over here. And I mean, we have to acknowledge no indicator is perfect. And the moon phases is estimated to be 74% accurate. So when this full moon printed, we still had momentum here, a little bit to the upside, but then, okay, so invalidating this moon phase. This one actually still played out a little bit. We had momentum to the downside, and then we made a high. So both these moon phases, not so great. Okay, but now we have a full moon that printed over here, pushing price up, and now we have a new moon. Is this new moon going to push the price down, or is it going to be a false signal where we come and claim the high? Okay, but I have to say that this indicator has a 74% accuracy rate, so there's definitely a chance that we do not claim the highs and the selling pressure starts kicking in. Okay, at the moment you can see as we printed this moon, price fell down. Right, but there's been a couple of false signals. This one printed, price fell down, and we took the highs. Okay, so let's see how this plays out. Right, for those of you that don't know the moon phases, I do have a video, and I will share it next week again. I'll maybe just broadcast it again, the moon phases. Very interesting when you go back in history and see how accurate it is. Okay, why is there no super chat button for me? I'm not sure, Valerie. I'm really not sure. Is there a maybe I switched it off by mistake? I'm not sure. Let's go look at what is cooking over here. Can I make comments? No, let me just close this. Okay. Oh, this is a different live stream. Let's do this. Go look at what is cooking over here. Can I make oh, I have super chats. So it looks like the super chat is definitely working. I'm not sure why you don't have super chats enabled. Okay, I'm gonna say $66,000, 72,600. I'm just gonna say let's go for 72. Let's see. I'm feeling a little bit bullish. Let's see what Jerome Powell does for us over here. Okay, remember legends down in the description, or up here in the description in my case, Bluffin, Bybit, and 𝗞𝗖. I'm really enjoying Bluffin here at the moment from a non-KYC perspective. I know 𝗞𝗖 has mentioned, I can't remember the exact date, either the 28th of June or the 28th of July. Can't remember the exact date. You're going to have to start KYCing. So I'm enjoying Bluffin here as a alternative to no KYC, and I've been told for a long time no KYC. I don't know how long a long time is, but let's see. Right, 5 more minutes. 5 more minutes. Let me do this. Put this live.
For corporate Europe.
Dr. Elarian,
I'm not sure.
Help me translate this, and you can do this out of the
If
𝗞𝗄s
they're going to
Library in
broadcast it
Cambridge.
here over this channel.
What in God's name
let's
is...
keep an eye on this channel and see if they're going to broadcast it over here. I did search for FOMC meeting live. Let's see. I think they're just talking a little bit of gibberish in preparation for Mr. Powell. Mr. Powell. Okay. Legends, I want to look at the poll here quickly. Let's see what the poll says. Why can't I see the poll? 56 of you guys saying 72,160 comes first. Okay, so we have some bullishness in the air. 72. Yeah, here we go. So 56 of you guys are saying we're going to take the highs before we take the lows. Interesting. Right, very interesting. Let's see what happens. I believe in the phase. Yes. Talking about, okay, I've gone through that. Dinesh, do we have a range low after the green candle at... Dinesh, I'm not sure if our time zones are exactly the same. Let me take the moon phases here out the way. Let's go on to the 4-hour time frame. Okay, and I suppose I can take some of these levels out at the moment. I don't need these levels anymore. I am going to keep this level over here, and I'll show you guys why I'm keeping that level, but I can take these ones out. I'm going to leave my go higher over there, switch off the VWAP. Okay, 230 for me was around about today, 230. Yeah, do we have a value area low? Do we have a range low after the green candle? I'm not sure, Mr. Dinesh, I'm not sure. Okay, we need to hold this value area high over here. Okay, if we can keep above this value area high, if we find continuation here to the downside, there's a possibility if we can hold this area, we can get a bounce if we do get a dip here to the downside. But you can see how we're holding the trend. Okay, people are waiting for Mr. Powell. We're holding the trend. Are we going to get that explosive move here to the upside, or are we going to break down? Okay, I just want to check something else here quickly, just thinking out loud. If I take a fib, 1, 2, 3, 4, I just want to see something here. Yeah, legends, if we come back down here to the 618, can this be a 1, 2, 3? I don't really see 5 waves inside of this move, unless this is 1, 2, 3, 4, 5. Doesn't really look good. Doesn't really look good, but I mean, let's see how this plays out. Maybe on the smaller time frames. 1, 2, 1, 2, 1, 2, 1, 2, 3, 4, 5. Okay, 1, 2, 3, 4, 5. This could be the end of the structure, or this is busy. 1, 2, 3, 4, 5. It's not clear, not really clear yet at the moment. Okay, but we're fighting the trend. We are fighting the trend. Let's see what happens over here. 1 more minute left. Let's see.
The entire world, as we saw earlier this morning.
2-year all over the place. We're down 12 basis points today, 471. In just a moment, that door's going to open and Fed Chair Jay Powell's going to walk in. There's going to be a lot of questions, but the number one question we all have in the last 30 minutes is, did you factor in the inflation report that came out at 8:30 Eastern Time into the forecast you just unveiled 30 minutes ago? I don't think there is another question to ask in this press conference once it starts.
And Michael Gapin put it really well. If the answer is no, we did not, well, it's not that.
Oh, we just lost sound.
Important thing I heard was from Bob Michel,
there we go.
and it was him talking about parts of America.
A new name for
This
Bob
is going to be a little bit boring. We're going to go through the
Talking about parts of America that are not enjoying this financialization, they're not enjoying it as haves. And to me, John, that's a key issue.
Here's the chairman of the Federal Reserve.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Our economy has made considerable progress toward both goals over the past 2 years. The labor market has come into better balance, with continued strong job gains and a low unemployment rate. Inflation has eased substantially from a peak of 7% to 2.7%, but is still too high. We are strongly committed to returning inflation to our 2% goal in support of a strong economy that benefits everyone. Today, the FOMC decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. We are maintaining our restrictive stance of monetary policy in order to keep demand in line with supply and reduce inflationary pressures. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has continued to expand at a solid pace. Although GDP growth moderated from 3.4% in the fourth quarter of last year to 1.3% in the first quarter, private domestic final purchases, which excludes inventory investment, government spending, and net exports, and usually sends a clearer signal on underlying demand, grew at 2.8% in the first quarter, nearly as strong as the second half of 2023. Growth of consumer spending has slowed from last year's robust pace, but remains solid. And investment in equipment and intangibles has picked up from its anemic pace last year. Improving supply conditions have supported resilient demand and the strong performance of the U.S. economy over the past year. In our summary of economic projections, committee participants generally expect GDP growth to slow from last year's pace, with a median projection of 2.1% this year and 2.0% over the next 2 years. In the labor market, supply and demand conditions have come into better balance. Payroll job gains averaged 218,000 jobs per month in April and May, a pace that is still strong, but a bit below that seen in the first quarter. The unemployment rate ticked up, but remains low at 4%. Strong job creation over the past couple of years has been accompanied by an increase in the supply of workers, reflecting increases in participation among individuals aged 25 to 54 years and a continued strong pace of immigration. Nominal wage growth has eased over the past year, and the jobs-to-workers gap has narrowed. Overall, a broad set of indicators suggests that conditions in the labor market have returned to about where they stood on the eve of the pandemic, relatively tight but not overheated. FOMC participants expect labor market strength to continue. The median unemployment rate projection in the 𝗖𝗍𝗄 is 4.0% at the end of this year and 4.2% at the end of next year. Inflation has eased notably over the past 2 years, but remains above our longer-run goal of 2%. Total PCE prices rose 2.7% over the 12 months ending in April. Excluding the volatile food and energy categories, core PCE prices rose 2.8%. The Consumer Price Index, which came out this morning and tends to run higher than the PCE price index, rose 3.3% over the 12 months ending in May, and the core CPI rose 3.4%. The inflation data received earlier this year were higher than expected, though more recent monthly readings have eased somewhat. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households and businesses and forecasters, as well as measures from financial markets. The median projection in the 𝗖𝗍𝗄 for total PCE inflation is 2.6% this year, 2.3% next year, and 2.0% in 2026. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. In support of these goals, the committee decided at today's meeting to maintain the target range for the federal funds rate at 5.25% to 5.5%, and to continue reducing our securities holdings. As labor market tightness has eased and inflation has declined over the past year, the risks to achieving our employment and inflation goals have moved toward better balance. The economic outlook is uncertain, however, and we remain highly attentive to inflation risks. We've stated that we do not expect it will be appropriate to reduce the target range for the federal funds rate until we have gained greater confidence that inflation is moving sustainably toward 2%. So far this year, the data have not given us that greater confidence. The most recent inflation readings have been more favorable than earlier in the year, however, and there has been modest further progress toward our inflation objective. We'll need to see more good data to bolster our confidence that inflation is moving sustainably toward 2%. We know that reducing policy restraint too soon or too much could result in a reversal of the progress that we've seen on inflation. At the same time, reducing policy restraint too late or too little could unduly weaken economic activity and employment. In considering any adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. In our 𝗖𝗍𝗄, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate, based on what each participant judges to be the most likely scenario going forward. If the economy evolves as expected, the median participant projects that the appropriate level of the federal funds rate will be 5.1% at the end of this year, 4.1% at the end of 2025, and 3.1% at the end of 2026. But these projections are not a committee plan or any kind of a decision. As the economy evolves, assessments of the appropriate policy path will adjust in order to best promote our maximum employment and price stability goals. If the economy remains solid and inflation persists, we're prepared to maintain the current target range for the federal funds rate as long as appropriate. If the labor market were to weaken unexpectedly, or if inflation were to fall more quickly than anticipated, we're prepared to respond. Policy is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. We'll continue to make our decisions meeting by meeting, based on the totality of the data and its implications for the outlook and the balance of risks. The Fed has been assigned 2 goals for monetary policy: maximum employment and stable prices. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored. Restoring price stability is essential to achieving maximum employment and stable prices over the long run. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
So that was basically reading the minutes, so nothing
Mr. Chairman,
of a surprise.
CNBC.
This is where the
Just
action
wondering
starts.
if you could
This is where the
walk me
action
through
starts.
the committee's average inflation forecast. Core PCE is now forecast to be 2.8% by the year end. It's already 2.75, and after today's number, there were several forecasts on the street that it would be 2.6 at the end of this month. Does that tell you that the average official expects no further progress in inflation, and in fact that it's going to get worse? And if you have this wrong, doesn't it mean that you could have wrong the outlook for rates there?
Yeah, so what's going on there is that we had very low readings in the second half of last year, June through December, really. And we're now lapping those. So as you go through the 12-month window, a very low reading drops out and a new reading comes in. The new reading gets added to the 12-month window. So it's just a slight element of conservatism that we're assuming a certain level of incoming monthly PCE and core PCE numbers. We're assuming, a good but not great numbers. And if you put that on top of where we are now, you get a very slight increase in the 12-month reading. Now, do we have high confidence that that's right? No, it's just a kind of conservative way for forecasting things. If we were to get more readings like today's reading, then of course that wouldn't be the case. So it's just a forecasting device. I think. Let me say that we welcome today's reading and hope for more like that.
But if it comes in, just to follow up, it comes in the way you forecast it, it would seem strange for you to be cutting rates at all in context of a rising core PCE. Thank you.
Yeah, no, I mean, I think what we said is that we don't think it'll be appropriate to reduce rates and begin to loosen policy until we have more confidence that inflation is moving back down to 2% on a sustainable basis. And that's the test we've applied. I don't know that this rules that in or out. I mean, really, it's a forecast, a fairly conservative forecast, month by month, that would lead to slightly higher 12 months rates by the end of the year. If we get, better ratings than that, then you will see that come down or remain the same. If you're at 2.6, 2.7, that's a really good place to be.
Nick Tamaros of the Wall Street Journal.
You really struggled with
Chair
that
Powell,
question.
if I look at the rate projections, I see 15 of the 19 that are anticipating either one or two cuts this year, fairly evenly split between the two. And so I wonder if you could explain a little bit more the nuances or the differences there. Would 2 or 3 more inflation readings, like the one that we saw this morning, make a September interest rate cut possible?
Very direct question.
So as far as the SEP part of that is concerned, as you know, I talk to all of the other participants on the FOMC every cycle, and we talk about their summer of economic projections and the their dot plot and everything. And what I hear and see is that people are looking at a range of plausible outcomes, and in many cases they're thinking, I can't really distinguish between two of these. They're so close for me. These are very close calls. But we ask them to write down the most likely one, so they do. And I think as you've said, there's 15 of the 19 are kind of clustered around one or two. So I think I would look at all. I look at all of them as plausible, but I'd look at I think that does tell you kind of what the committee thinks. But what everyone agrees on is it's going to be data dependent. No one brings to this or takes away from it, that is on the committee, a really strong commitment to a particular rate path. It's actually just their forecast and it's a combination of their forecast and their own reaction function. But again, everyone would say that this is very data dependent, and I don't hold it with high confidence. And I think if you're looking for and don't really think that they're not trying to send a strong signal that this is what I think is the right thing. It's just what they think at a given moment in time, subject to data. In terms of future meetings, we haven't, we don't make decisions about future meetings until we get there. I think in terms of what we need to see, I mentioned it earlier, we want to gain further confidence. Certainly more good inflation readings will help with that. I'm not going to be specific about how many because really it's going to be not just the inflation readings, it's going to be the totality of the data. What's happening in the labor market, what's happening with the balance of risks, what's happening with the forecast, what's happening with growth. You look at all of that and you ask, are we confident? Have we reached an appropriate level of confidence that inflation is moving down sustainably to 2%? Or alternatively, do we see really unexpected signs of weakness in the labor market that would call for a response? Which is another thing that could happen. But again, we don't see that. And we see today's report as progress and as building confidence, but we don't see ourselves as having the confidence that would warrant beginning to loosen policy at this time.
And if I could quickly follow up, did you or any of your colleagues change your interest rate projections after 8:30 or whenever you got the inflation numbers today?
So this happens too often, but it does happen. It just is, data came, I think it happened a few meetings ago. So when that happens, when there's an important data print during the meeting, first day or second day, what we do is we make sure people remember that they have the ability to update. We tell them how to do that. And some people do, some people don't, most people don't. And I'm not going to get into the specifics, but you have the ability to do that so that what's in the SEP actually does reflect the data that we got today to the extent you can, reflect it in one day. I think you will see PPI tomorrow. We'll know more about the PCE reading as the month goes on, but the initial CPI reading and its, kind of first level translation to PCE we did have this morning. We were briefed about it, and people were able to consider whether they should make changes. And as I said, some people generally do, but most people generally don't.
Wow. Let's talk about dancing around a question. I mean, you spend a lot of time saying nothing.
Hi,
So
Chair Powell,
diplomatic.
Janelle Marte from Bloomberg.
And
As you noted, the labor market is now in many ways back to where it was before the pandemic.
Yes.
I wondered if you could comment on how officials are viewing that. So do you think that there still needs to be more cooling in the labor market to bring inflation all the way down to 2%? Or is there any sense that maybe the labor market is more vulnerable now to higher rates now that many of those imbalances have eased?
Sure. So by so many measures, the labor market was kind of overheated 2 years ago, and we've seen it gradually move back into much better balance between supply and demand. So what have we seen? We've seen labor force supply come up quite a bit through immigration and through recovering participation. That's ongoing mostly now through the immigration channel, but still we've had some increases in prime age labor force. In terms of on the demand side, we've seen quits moving down. We've seen job openings moving down. We've seen wage increases moving from very, very high levels a couple of years ago back down to more sustainable levels. We have seen unemployment creep up now 0.6 over the course of a year or so, very, very gradually. So you put all that together, what you have is still low unemployment, still 4% unemployment, historically low. but it's moved up a little bit. It's softened a bit, and that's an important statistic. But more than that, you've got strong job creation. You have payroll jobs still coming in strong, even though there's an argument that they may be a bit overstated, but still they're strong. So that's what we see. We watch the labor market, of course, and the economy as a whole, but the labor market very carefully, and that's what we see. We see gradual cooling, gradual moving toward better balance. We're monitoring it carefully for signs of something more than that, but we really don't see that.
As a quick follow-up, the surveys that make up the jobs report are showing different tales. There's been some divergence, especially we saw in the last report that we got on Friday. So how do you interpret that, and how does it change your view on the labor market?
So sometimes you can't reconcile the differences. You just have to look at it and try to understand, and that's why it always makes sense to look at a series, in 3, 6, and 12 months of things rather than just one report. But you're right to point to the last report where there were job losses in the household survey, job gains, big job gains in the establishment survey. So, we're left with ambiguous results, and we have to deal with that uncertainty around data. Nonetheless, the overall picture is one of a strong and gradually cooling, gradually rebalancing labor market. Job openings, while they've come way down, are still, greater than the number of unemployed people. The jobs workers gap is still a significantly positive number, greater than it was before the pandemic. So overall, we're looking at what is still a very strong labor market, but not the superheated labor market of 2 years ago or even 1 year ago.
Thanks, Chair Powell. Neil Irwin with Axios. Back on the rates path, the SEP showed a quite large shift of rate cut expectations relative to March. That's a period in which the economic data flow hasn't been that dramatic a shift. Can you provide some color on what changed in attitudes on the committee over the last 3 months to see a much shallower path of rate cuts this year?
Yeah, the big thing that changed was the inflation forecast. So the inflation forecast moved up several tenths for the end of the year, and as I mentioned earlier in the, what did we take away from this? We had really good inflation data in the second half of last year, then kind of a pause in progress in the first quarter, and what we took away from that was that it's probably going to take longer to get the confidence that we need to begin to loosen policy. So the sense of that is that rate cuts that might have taken place this year take place next year. There are fewer rate cuts in the median this year, but there's one more next year. So if you look at year-end 2025 and 26, you're almost exactly where you would have been. Just it's moved later because of that progress. Now you get different data today. So we'll have to see where the data light the way. The economy has repeatedly surprised forecasters in both directions, and today was certainly a better inflation report than almost anybody expected. And we'll just have to see what the incoming data flow brings and how that affects the outlook and the balance of risks.
Okay, so basically just data.
Gina Smiley, New York Times. Thanks for taking our questions. In the summary of economic projections, the long-run interest rate forecast moved up a bit. I wonder if we should read that as a sign that you think that policy is not sort of as restrictive as we previously expected. How should we interpret what that means about how the committee views its current policy setting?
So 2 things about that. One is this. You're right, it did move up, but I want to remember to point out that long-run neutral rate of interest is a long-run concept. It really is a theoretical concept, can't be directly observed, and what it is the interest rate that would hold the economy at equilibrium, maximum employment, and price stability, potentially years in the future where there are no shocks. So it's a little bit, it's not something we observe today. Today we've got a very specific economy with all kinds of shocks we're still getting over from the pandemic. So it's, I don't think that the concept of R-star, it's a very important concept in economics and in what we do, but honestly it doesn't really get you where you need to be to think about what appropriate policy is in the near term. But back to your original question, people have been gradually writing it up because I just think people are coming to the view that rates are less likely to go down to their their pre-pandemic levels, which were, very low by recent history measures. Now, we can't really know that. That's an interesting dispute and discussion to have now, but ultimately we think that things like the neutral rate are driven by longer run, slow-moving forces, and there's a really good question about whether those really have changed or whether instead rates and the economy are experiencing a series of persistent but ultimately temporary shocks. That's been the debate. And we can't know. But in the meantime, we're making policy with the economy that we have, with the distortions that we have. And I also, to your other point, I think it is the case that as time has gone by, the question of how restrictive is policy has become one that everyone's asking, and we're asking it too. And my answer has been that policy is restrictive. The question of whether it's sufficiently restrictive is going to be one we know over time. But I think for the reasons I talked about at the last press conference and other places, I think the evidence is pretty clear that policy is restrictive and is having the effects that we would hope for.
Well, thanks to your pal Howard Schneider with Reuters. Just to carry that a little further, should we read this as a conclusion, the combination of tipping to one cut this year and acknowledging further progress on inflation as kind of a mark to market on the level of restrictiveness that you need, that you in fact have concluded that you weren't quite there yet?
I'd be reluctant to try to draw that conclusion. I think this is about looking at the incoming data and asking how much progress are we making on inflation and how is the rest of the economy doing? Is the labor market still strong? That's what we're thinking about. You can translate it into the language you're talking about, but to me the focus is more on we have a goal which is price stability, another goal which is maximum employment. How are we doing there? We think we've got a good, strong labor market still. We think we've been making progress toward the price stability goal, and then for a while there was a pause, and we look at today's thing and we think, well, that's a good reading, and we hope we get more like that. And in the meantime, we're asking, is our policy stance about right? And we think yes, it's about right. We're prepared to adjust it as appropriate, but we think we're getting the things that we would want to get, broadly speaking, and that's why we've been at this policy right now for almost a year.
So just to follow up on that, I think one curious thing here is you've got now this restrictive policy in place and virtually no change in any of the major things for all of this year. You've got growth that stays above long-run potential throughout the forecast period, unemployment that never goes above the long-run estimate, right, of 4.2. So this isn't a story of slack improving inflation. So where's the improvement in inflation coming from that it's going to pick up pace so much in 2025?
Well, it's been coming. Where's it been coming from? We'll start with that. Clearly, a lot of some of what we've been getting is just the reversal of the unwinding of the pandemic-related distortions to both supply and demand, and that is complemented by and amplified, supported by restrictive monetary policy. So those two things have been working together. We've also had a very positive supply shock on the labor side, and also you get a positive supply shock when the supply conditions unwind and return to normal. So you've had above trend potential growth and high growth, and yet you've had the benefit of inflation coming down, really fast actually last year, and we'll see what the rest of this year brings. So these dynamics can continue as long as they continue. Ultimately, the question is are you down to demand? And we don't know that though. We're look at today's report. If we see more like that, we can't know what the future holds. But in the meantime, we've made pretty good progress on inflation with our current stance.
Michael McKee from Bloomberg Radio and Television. The base case of the committee seems to be that there is going to be at least one rate cut this year, but your growth forecast doesn't see any slowdown in the rest of the year, nor does the unemployment forecast see any significant weakening of the labor market. And your inflation forecasts basically average out to no change. So if at the end of the year there is no change from conditions now, why would you anticipate cutting rates? What would be the point for a rate cut?
Well, we think policy is restrictive. And we think ultimately that if you just set policy at a restrictive level, eventually you will see real weakening in the economy. So that's always been the thought, is that, since we raised rates this far, we've always been pointing to cuts at a certain point. Not to eliminate the possibility of hikes, but no one has that as their base case. So no one on the committee does. So that's how we think about it, and that's what we've been getting. That's what we've been getting is good progress on inflation, with growth at a good level, and with a strong labor market. Now, ultimately, we think rates will have to come down to continue to support that, but so far they haven't had to, and that's why we're watching so carefully for signs of weakness. We don't really see that. We kind of see what we wanted to see, which was gradual cooling in demand, gradual rebalancing in the labor market, while we're continuing to make progress on inflation. So, we're getting good results here.
Well, to follow up, is there any kind of concern for the housing industry or financial stability, banks, in leaving rates where they are for too long at this point?
On housing, the housing situation is a complicated one, and you can see that's a place where rates are really having a significant effect. Ultimately, the best thing we can do for the housing market is to bring inflation down, so that we can bring rates down, so that the housing market can continue to normalize. There will still be a national housing shortage, as there was before the pandemic. There will still be one, but the distortions that we see now with lock-ins and things like that, low mortgages. In terms of banks, the banking system has been, solid, strong, well-capitalized, lending. We've seen good performance by the banks. We had the turmoil early last year, but banks have been focusing on bringing up their liquidity, bringing up their capital, and having risk management plans in place. So the banking system, seems to be in good shape.
Chris.
Thanks, Chris Rugaber at Associated Press. I was wondering if we can. On inflation, if you can tell us a little more about where you see inflationary pressure in the economy. You mentioned labor markets coming into better balance, and inflation expectations appear to be well anchored. You're seeing, anecdotal stories of the large chains like Walmart and Target are announcing price cuts. McDonald's announcing a $5 meal deal. So, people may still be unhappy about prices at the grocery store, but it doesn't seem like there's a lot of inflationary pressure left in this economy. I wonder if you could tell us more about it.
I think it's true that inflationary pressures have come down, but we're still getting high inflation readings. So, and I think you can see it in various places. In some parts of non-housing services, you see elevated inflation still, and that's probably it could be to do with wages. Goods prices have kind of fluctuated. There's been a surprising increase in import prices on goods, which is kind of hard to understand, and we've taken some signal from that. But and of course, housing services, you're continuing to see high readings there. To some extent, that's catch-up inflation from earlier pressures. But overall, you're right. Inflationary pressures have come down. As I mentioned, the labor market has come into better balance. Wages are still running, I would say, above a sustainable path, which would be that of trend inflation and trend productivity. You're still seeing wage increases moving above that. We haven't thought of wages as being the principal, cause of inflation, but at the same time, getting back to 2% inflation is likely to require return to a more sustainable level, which is somewhat below the current level of increases in the aggregate.
Rachel.
Hi, Chair Powell, Rachel Siegel from the Washington Post. Thanks for taking our questions. There's obviously a lot of focus on how many cuts could be expected this year, but can you give us a sense of what one cut by the end of the year would actually do to the economy, what you think would be a meaningful difference if there was a cut by the end of the year, or even two?
I think if you look back in 5 or 10 years and try to pull out the significance to the U.S. economy of one 25 basis point rate cut, you'd have quite a job on your hands. So that's not how we look at it. Really the whole rate path matters, and I do continue to think that when we do start to loosen policy, that will show up in a significant loosening in financial market conditions. and the market will price in what it prices in. I have no way of saying, we're not at that stage, so I don't know what we'll be thinking about at that time. But it's a consequential decision for the economy, and you want to get it right. And fortunately, we have a strong economy, and we have the ability to approach this question carefully, and we will approach it carefully while we're very much keeping an eye on downside economic risks should they emerge.
And you've been talking about this clear sense that it's just going to take longer to have the confidence that's needed for rate cuts. Is there something about what happened in the first couple of months of the year that you're seeing differently now with more time or hindsight? Do you still characterize it as expected bumpiness or something more lasting that is affecting your policy for the rest of the year?
We always want to avoid the tendency to dismiss the parts of inflation that we don't like and just make it go away. But we had a quarter where inflation was running higher, and yes, I could stand here and say it's stuff we shouldn't have taken signal from, but it is what it is. You have to, low inflation is low inflation, high inflation. So if you have a quarter where it's higher, we tried not to take signal from the first couple of months, but we got a third month, and we said, okay, the signal we're taking is that we think it's going to take longer to get confidence that inflation is moving sustainably on 2%. That's what we said. I think that was the right thing to do. I still think that's the right thing to do. Now we have today's inflation reading, which is very different, very much more positive. We're going to have to see what the trend is, what's going to be the data going forward. We're looking for something that gives us confidence that inflation is moving sustainably down to 2%. And readings like today's, that's a step in the right direction. But one reading isn't. It's only one reading. You don't want to be too motivated by any single data point.
Jolene. Hi, Chair Powell. Thank you for taking our questions. I'm Jolene Kent with CBS News. What's your message to Americans who are seeing encouraging economic data but don't feel good about this economy?
I don't think anyone knows, has a definitive answer why people are not as happy about the economy as they might be. And we don't tell people how they should think or feel about the economy. That's not our job. People experience what they experience. All I can tell you is what the data show, which is we've got an economy that's growing at a solid pace. We've got a very strong labor market with unemployment at 4%. It's been a long time since we've had a long stretch of time with unemployment at or below 4%, very long time. We had a period of high inflation. Inflation has come down really significantly, and we're doing everything we can to bring that inflationary episode fully to a halt and fully restore price stability. We're confident that we'll get there. And in the meantime, it's going to be painful for people, but the ultimate pain would be a period of long period of high inflation. It is people who, lower income people who are at the margins of the economy who have the worst experience, who experience the most pain from inflation. So, it's for those people, for all Americans, but particularly for those people that we're doing everything we can to bring inflation back down under control.
As just a quick follow-up here, you've indicated one interest rate cut sometime this year, and I know you don't have a crystal ball up there, but a lot of people are watching and see, borrowing money remains very expensive. For everybody who's out there waiting on a rate cut, about when can consumers expect some relief?
Well, I don't have a precise date for you, but what we said is that we want to make sure that we're confident that inflation is actually moving back down to 2%. And when we are, then we can look at loosening policy. So having that kind of confidence that inflation will be at 2%, it just pays benefits to the whole economy, to all Americans for a long period of time. We had that period for a very long time. We very much want to get back to a place where people can not think about inflation. It's just not a concern in the everyday economic decisions that they make. We were there for a long time, and our goal is to get back to that place. And we've made good progress, and we're in the phase now of just sticking with it until we get it done.
Claire.
Claire Jones, Financial Times. Just drawing on the change in the statement on there being modest further progress on inflation. Halfway, through the year and after today's CPI release, what have you and other committee members found that has been particularly encouraging to you? And just in terms of the conservatism, how much of that is about stickiness in shelter inflation in particular? Thank you.
So encouraging has been that growth, the growth clearly that we had last year, and particularly the second half of last year, and we continue to see still strong growth or solid growth this year. That's been very encouraging. If you go back a year, there was a real concern about, very much slowing growth and a recession. Many forecasters had that, and that's not what happened. Instead, the U.S. is anyway, and it's in sharp distinction with many other advanced economies around the world. So that's been encouraging. I would say that today's inflation report is encouraging, but it comes after, several your reports that were not so encouraging. You ask about. Your second question was really about shelter inflation. So I think if you go back a couple of years, we know that there are renters, and then there are people who own their houses, and we have OER, which is owner's equivalent rent. And so when market-based rents go up sharply, as they did at the beginning when the economy reopened, they really went up sharply. Those play into rollover rents much more slowly for existing tenants than they do for new tenants. And so we found now that there are big lags. So there's sort of a bulge of high past increases in market rents that has to get worked off, and that may take several years. Nonetheless, as long as market rents are going up at relatively low levels, and they still are, this is just going to happen. It just is going to happen more slowly than we thought. We also do sort of this thing where we impute a rental value to owned homes, and that's many countries around the world do that. Some do it differently than us. It's something that the price experts have regularly looked at. It is not something that we're the only country that does, and it's not something we're looking at changing or would look at changing, anytime soon. But it's true. It's one of the very hardest things in inflation and in prices is how to think about, the services that someone is getting by living in a home that they could rent, but they're actually living in it. And some countries choose to just ignore that, but that's not how we do inflation here. We do it the way we do it, and we've been very transparent about it. And it's true that we're seeing delays in realizing what's happening economically, but we understand that. We understand that very well.
Edward. Edward Lawrence with Fox Business. Thank you for taking the question, Chair Powell. So I want to go back to jobs and the consumer. The last jobs report showed that over the past year, 634,000 more people took multiple jobs. That's up 8.2%. And since January of 2021, we've seen prices rise 19%. So people are using their credit cards to pay for their lifestyle. What pressure points will signal to you that the slowing economy could maybe break companies in terms of hiring or break the consumer in terms of spending?
So, we monitor all the things you mentioned and more. What we're seeing is basically spending was going up faster than disposable income during big parts of last year rather. And so what you'd expect to see is people spending more on their credit cards. That has been happening. Credit card balances have been going up. Credit card defaults have been going up. They're not at high levels. Remember that after the pandemic, people were cooped up. They couldn't spend money. They couldn't go out to spend money. They could spend money from home. But households were in very, very strong, historically strong financial shape. They've now worked off a lot of that. So we're watching that carefully. And, what do we see? That's what we see. We see the same data that everybody else sees. But you've still got household sector that's in pretty good shape. But nonetheless, it's not in the kind of shape it was in a year or two ago. And we're carefully watching that.
So how close then are we to that point where the consumer can't continue to spend as it's spending, or companies can't hire like they're hiring?
Consumer spending is still growing. It's not growing at the pace it was growing at a year or so ago, but it's still growing solidly. And by the way, other parts of the economy are picking up. Spending on equipment and intangibles has picked up quite a bit in the wake of all the construction that we saw of new tech plants. So overall, the economy is exhibiting solid growth, and something around 2%, which is a good pace of growth for the U.S. economy. But you're right, though. We do see the same thing other people see, which is increasing financial pressures on more lower income people, and the best thing we can do is to foster a very strong jobs economy, which we think we have done, ultimately to get inflation under control, because those people experience inflation, very directly, very painfully, and once we get inflation under control, rates can come down, which will also improve things.
Victoria.
Hi, Victoria Guida with Politico. You've mentioned that an unexpected weakening in the labor market would bring rate cuts sooner, and I was just wondering, can you talk a little bit about what that would look like? Is it more of like a quicker pace of people losing jobs? Is it more the level of the unemployment rate if it were to start to go above 4.2 or something like that? How are you thinking about what you're looking for to see the job market unexpectedly weaken?
When I say unexpectedly, the first thing is more than kind of is in our forecast or in common forecasts. So something more than that. But we'll be looking at everything. The labor market, has the ability, has the tendency sometimes to move to weaken quickly. So waiting for that to happen is not what we're doing. We're watching very carefully. We're looking at the balance of risks. I always point out the balance of risks. So. And also the fact that we look at all of the whole situation. So, a decision to begin to, loosen policy could have several reasons associated with it at a given time. But I would just, we monitor all the labor market data, and if we saw troubling weakening more than expected, then that would be something we'd consider responding to. But we look at the broader context of what's going on too.
So something like negative payroll numbers would be.
I'm not going to. I can think of things many things would make it on that list, but I don't think I'll utter them here.
Thank you, Chair Powell. Simon Rabinovich with The Economist. May I ask, you mentioned with the slightly higher PC readings earlier this year that it wasn't 1 or 2 months, but 3 months that tipped you to be a bit more cautious in the rate outlook. Should we take from that it looks like May will be quite good for PC as it was for CPI? Does that imply that kind of 2 more good months would reinstill the confidence that rate cuts could be coming sooner than you currently project?
I don't actually have that kind of mechanical thing in my thinking. I get that, as many good ones as we had bad ones, but no, it's not like that. It's the whole. It's going to be the totality of the data, the labor market data, the growth data. In terms of inflation, you'd want to see real progress that builds your confidence that we are on a path down to 2%. And I don't want to try to give you specific numbers of things, because that points to dates, and I just don't think we're not at a point of being able to do that.
Thank you for doing this. I'm 𝗖𝗆cie 𝗿𝗍𝗄𝗍 with Nikkei. I would like to know about the impact of stronger dollar on U.S. economic growth and prices. And I have no doubt that the market should determine the exchange rate, but Japan and some emerging markets are suffering from the strong dollar. So I want to know if it is having a positive impact on U.S. economy in total. Thank you.
So we don't. Actually, it's our finance ministry, the Treasury Department, that has a responsibility for thinking about and if it sees fit, doing things about the level of the dollar. So for us, it's just another financial variable. And you're right, the dollar has exhibited some strength over the course of the last year or so because the U.S. economy is very strong. We don't think of it as benefiting or hurting the U.S. We don't manage the level of the dollar. That's not our job. It's not, and for our economy, what we're trying to foster is maximum employment and price stability, and we feel like we've made good progress on both of those goals over the course of the past year.
Jennifer.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. You said you would cut rates before inflation falls to 2%. You're forecasting inflation to end the year at 2.8% on core PCE. We're at 2.8%, of course, on core PCE. Right now, you said the inflation forecast is conservative and that if you got 2.6 to 2.7 on PCE, that would be a good place to be. You also indicated the job market has mostly normalized. So why not cut rates this summer just once? You're well above neutral to try to preserve the soft landing rather than risking waiting too long in the quest for confidence for inflation.
You know, so we're well aware of the two-sided risks here. Let me just say, we understand that if we wait too long, that could come at the cost of economic activity, of employment, of the expansion. We understand that if we move too quickly, we could end up undoing a lot of the good that we've done and have to then start over, and it could be very disruptive. So we're extremely aware of both of those risks and just basically trying to manage them. And what we said is that we don't think it'll be appropriate to begin to loosen policy until we're more confident that inflation is moving down to 2% over time on a sustainable basis. That's kind of been our test. Or there's another test, which is, you know, an unexpected deterioration in labor market conditions. So I think that's the right way for us to think about it. That's our dual mandate there. And, you know, we have a strong economy. We've got growth. All forecasts are very commonly around 2%. That's a strong growth rate for our economy. The labor market continues to print jobs at a pretty high rate. Unemployment's still low, so we have the ability now to approach this question carefully, and that's what we're doing.
And just to follow Chair Powell, do you need to be ahead of a weakening in the labor market? Otherwise, is it too late, given that the labor market is a lagging indicator, right, when you look at the monthly jobs data?
Yeah, we completely understand that that's the risk, and that's not our plan, is to wait for things to break and then try to fix them. We're trying to balance these two goals in a way that is consistent with our framework, and we think we're doing that.
Evan.
Thank you, Chair Powell. Evan Reiser with Market News International. You have mentioned before the framework review process will start in the latter half of the year. At this point, do you have any specific time frame for the start of that? Who will lead it? Will it be you or a committee group of your peers? What will be the parameters? Do you anticipate the review will consider changes to communications going forward?
So what we've been thinking is that we would announce and commence the review later or late in the year. In the meantime, as that time approaches, we will be devoting a lot of careful thought and planning to the contours of it. Within scope would certainly be communications generally. I'm not going to say that we'll look at this or that particular thing. And all the other details, we don't want to get prematurely into a conversation until it's really time to have it. And so, I'm going to leave pretty much everything else to later in the year.
Go to Nancy for the last question.
Hi, Chair Powell. Nancy Marshall-Genzer with Marketplace. Just one more question on housing. Can you still cut rates with shelter prices high, or will you wait until they start to moderate a bit?
I wouldn't. There isn't any one variable like housing prices moderating that would really decide against what we're doing. We've got an overall test, which is greater confidence that inflation is moving down to 2% on a sustainable basis. That's our overall test. Or, alternatively, we see unexpected weakening in the labor market. So those are two different tests. I would say, we're not looking at any one price in any one sector and saying that's the one. We don't target housing prices, for example. And we don't target wages. We target aggregate prices and overall employment. So,
but if housing prices remain sticky, could that slow down the pace of rate cuts?
I think you'd look at we'd be looking at the aggregate numbers, and asking ourselves what's going on here with inflation at the aggregate level, and of course, if any price that contributed to ongoing inflation would matter. Any price that contributed to ongoing disinflation would matter too. But I wouldn't single out housing as having a special role there. Thank you very much.
The chairman of the Federal Reserve, Jerome Powell, wrapping up the June Fed decision. No change at the Federal Reserve to interest.
Right, legends. Oh my goodness. What a boring speech. Interesting nonetheless. But nothing really happened. Legends, the one thing that I was highlighting for you guys here over the stream is that while we were having the momentum here to the downside, the one thing I just wanted to highlight is that, well, if this is an ABC, okay, C waves really has like an extended target of the 1.618. So for bullish momentum to continue here to the upside, you really want to see the 1.618 hold. Okay. And perhaps that will give us the momentum to the upside. But like Tortuga has pointed out now, I want to go and have a look at CVD. So let's just enlarge this, take the scribble out the way. Let's refresh it because sometimes it gives a little bit of bugs. So I just want to make sure that it's nice and fresh. And Mr. Tortuga, let's go see what is happening over here, okay? No bearish. Okay. I see, okay, I see what you're seeing over here. So between this pivot and this pivot, I see on yellow, we are making bearish CVD and this little pivot over here. Okay, and then also between these pivots and where price is at the moment on blue, we are making bearish CVD and on yellow. So perhaps price is going to start falling down here. Obviously, if price moves up, it invalidates the bearish CVD, okay, and then we can continue momentum here to the upside. So I do spot the bearish CVD, but legends, like I've said during the beginning of my stream, that CVD usually tells a beautiful story. And for those of you that joined late, look at the story that CVD told us over here. Price was falling down, CVD was moving up, showing massive absorption of longs, where the bigger players, the smart money, is pushing price down here. Okay, well, retail money. So wait. Yeah, smart money is pushing the price down while retail is trying to long. Okay, and then you have bullish CVD finally between this pivot and this pivot, and look at the momentum you got to the upside just with this little clue over here. Okay, but for now, I do see, Mr. Tortuga, I agree with you. I do see some local. I want to see if there's some bullish CVD. Okay, I mean, from a bullish perspective, it's still far away. I would like to see bullish CVD against this pivot over here. And there is, yellow still needs to come down a little bit further. And blue is all the way down here. So for now, based on what I'm seeing over here, the probabilities looks higher for price to find continuation to the downside. Okay, legends, I know the speech was boring, and I'll most probably do this every single month where we can go and watch Jerome Powell just say that it's data-driven decisions. It's interesting to see the price movements. For those of you that, just spend some time together, make some comments, share some love. I appreciate everyone joining the stream. And if we lose the 1.618 level over here, next stop, 2.618 at $67,912, and there we lose it. The other thing I wanted to point out, and I couldn't really say it while Jerome was talking, is that we have a range low, and we've tapped it multiple times, which increases the probabilities that you're going to come fill the gap. Okay, so let's see what happens when we bounce on this trend over here together with a 2.618. Okay, perhaps that will give us momentum to the upside, or we are going to make a lower high and continue the momentum to the downside. Okay, legends, thank you so much for joining. Smash up the like, hit subscribe for future notifications. I think that's a wrap for me. I've been on the stream for an hour and a half, my longest stream so far. I appreciate every single one of you coming through to watch Jerome Powell with me. And not a lot of education today, but I promise I'll be back in full force tomorrow, educating everyone for those next trading setups so you can catch the fish yourself and you don't rely on any signals from anyone else. Legends, have an awesome evening. Until tomorrow, cheers for now.